Well, in December 2023, BHP's shares were sitting above $50. Now they're just above $41. The collapse in iron ore prices has taken a big toll on our major miners. This week, BHP said its half-year profit fell 23% to $5.1 billion. That's despite record iron ore shipments, but its revenues fell 8%, and that's because of the slump in commodity prices and iron ore in particular. Its interim dividend of 50 US cents a share is BHP's lowest payout to shareholders in 8 years. Well, this week I caught up with BHP Chief Executive Mike Henry, who has a big message for politicians to simply not presume the big Australian will keep investing tens of billions of dollars here. But I started it by asking him if the company and its many tens of thousands of Australian shareholders are now overexposed to China's economy.
Well, let me start by saying, Ross, that we have a very resilient business, be it the balance sheet, be it the portfolio that we hold. So if you think about the commodities that BHP produces, they have very resilient end-use demand. Yes, of course, like most commodities these days, if there's economic headwinds in China, that impacts everybody everywhere. But within the sector, we have the best commodities, and we've got assets that sit at the low end of the cost curve. And the implication of that is that we have higher margins, so we're a full 10 percentage points ahead of the competition when it comes to our average margins. And so when you do see price volatility due to economic headwinds, be it in China or elsewhere, we're best positioned to weather that volatility. So I'm pretty pleased with where we're at. The underlying business is performing well. You'll see that coming through in the results, both operationally and financially. And firing on all cylinders right across the group, be it the record shipments in iron ore in the second half, the 14% growth in coal production in Queensland from this world-class steelmaking coal business that we have there, through to the exciting 10% growth in copper, which keeps us on track for 24% growth in copper by the end of this half, bang in line with the strategy that we've laid out.
Well, having spoken to BlueScope Steel earlier this week, they're talking about a flood of cheap Chinese steel hitting the world markets right now, which may only be exacerbated by US steel tariffs. From your point of view, providing the iron ore and the coal to make that steel, especially in China, what changes for you in regards to those tariffs?
Well, so first of all, let me say that there's very little direct steel being exported out of China to the US. So first-order impacts of U.S. tariffs aren't going to be that significant on Chinese steel exports. Of course, one always has to think about, well, if you have tariffs and counter-tariffs, what's the impact on overall global growth? And that could have some impact over time. But if we look at the Chinese government's position, they've reiterated the pro-growth stance. We believe that they will calibrate their policies to support the domestic economy basis what they see happening in export markets. So we've had 6 years running now of 1 billion tons plus steel production in China. Lots of iron ore needed by the blast furnace steel mills blast furnaces there. And we expect that steel production, iron ore demand is going to remain healthy. We've got a business, though, that is positioned for what we believe is going to be greater competition coming in iron ore markets over the remainder of the decade. It's why we position ourselves at the low end of the cost curve. We've been the best performing business now for 5 years running, and we have healthier margins than the competition. So we are very well positioned in that business, as we are in our other businesses.
So notwithstanding that, you still have decisions to make about investing capital in future iron ore expansions in Australia. Of course, they're decisions that will be dependent not just on BHP and its shareholders, but also even on government settings at the time. Tell me how you assess that, especially against what is likely steel demand and supply coming out of other parts of the world.
So what we're doing right now, Ross, is we're creating options for us, options for ourselves and for shareholders. And so we'll have some studies finished by the end of this calendar year into potential expansions of our iron ore business up to 330 million tons per annum. Of course, at that point in time, we need to look at, number one, what do we see by way of the outlook for iron ore demand, iron ore prices? We have to compare the attractiveness of those projects against other investment opportunities across the group, or returning more cash to shareholders. And one of the things we take great pride in, and we've been so focused on, is capital allocation and our discipline around that, which means that that projects have to compete for capital within the BHP portfolio. And in assessing the attractiveness of expanding to 330 million tons in iron ore, we also have to take into account the input settings for those investments. And that comes back to things like the attractiveness of tax settings, the input costs of labor, and so on and so forth. And it's only when we look at that full equation, the market dynamics, the cost of building the project, the ongoing cost of operating it, and how that compares against other alternatives, be it in copper or potash or both here in Australia and elsewhere in the world, that we would then make a determination as to whether to proceed with those expansions or not. But right now we're focused on giving ourselves the option to be able to pursue those growth projects should circumstances warrant it.
You and I sit here right now today. Is Australia sufficiently paying enough attention to its competitiveness to make certain that future investments from BHP and other similar companies happen here in Australia and not elsewhere?
I think this is getting increasing focus and debate right across the country, Ross. And you see more businesses, more business associations, more policymakers coming out and advocating for a sharper focus on ensuring that Australia remains competitive. The reality is that we are going to face some economic headwinds as a country over the next 20, 30 years. In order to meet those headwinds and, in fact, continue to grow the economy and grow living standards for all Australians, we are going to have to be able to not only ensure that existing businesses remain globally competitive, but that we're able to spawn and grow new export-oriented opportunities, industries here in Australia in the coming years. And that is going to require us all collectively, be it the business community, state policymakers, federal policymakers, to lean into this together to figure out how we can ensure that we stay one step ahead of the pack, keeping in mind that those that we're competing with are certainly making some aggressive and bold moves to improve their competitiveness.
Okay, so Mike, a little earlier you spoke about the overarching themes of BHP with its investments, which includes, population growth and also the energy transition. But for the first time today, you included data centres and artificial intelligence as part of the strategic mix. So I'm just wondering, what metals do they require that BHP currently does not mine?
Well, I'll come back to one of the reasons we've outlined it is because they are copper intensive. If you think about these data centers, they require more electricity. They're copper intensive themselves. And what we're trying to illustrate there is that we have the baseline attractiveness of a commodity like copper because it's needed just for the basic functioning of the global economy today. And the world's going to need more copper as population grows and standards of living rise. But in addition to that, both the decarbonization thematic and the digitization or data center thematic are copper intensive. And so we see particularly resilient end uses for copper and a number of these big megatrends coming together to compound that attractiveness. And we're very well positioned in that particular commodity. Now, data centers, digitization will require some other metals and minerals, including more by way of rare earths. But they don't. We've taken the view that those other commodities are not attractive for BHP because of lack of scale, so they don't move the needle for the company, or because we see the cost curve as being too flat to afford us opportunity to generate healthy returns for shareholders.
I'll tell you what, Mike Henry, it is always a fascinating time to talk to you because it is a big picture view of the world from BHP, and I appreciate your time.
Thank you, Ross.